Hello, I'm Jay Hirsch, Director of Administration of Columbia's ERM program. I'd like to welcome you to today's event, our CRO Spotlight panel featuring Senthil Kumar. Throughout the event, you may post any questions you have using the Q&A feature at the bottom of the screen. Questions will be answered at the end of the event. I'd like to tell you about some upcoming events you may be interested in. On all Fridays, we have our Coding for Risk Management seminars. On Saturdays, we have both our IQRM and Intro to Finance seminars. And on Thursdays, we have our Exploring the Power of Mindfulness seminars. And now I'd like to pass this on to our moderator, Sim Segal. Sim.
Thank you, Jay, and welcome to all those joining us today. We're proud to bring you today's event, which is another edition of our CRO Spotlight series, which features one-on-one interviews with leading chief risk officers. I'll now introduce myself and our featured guest. Excuse me. I'm Sim Segal. I'm founder and director of the ERM program here at Columbia University, the largest such program globally. I'm also president of Symergy, a consulting firm I founded 12 years ago, focusing exclusively on enterprise risk management, serving corporate entities across a range of sectors, as well as nonprofits and government agencies. I'm author of an ERM book called Corporate Value of Enterprise Risk Management, which I wrote to help executives advance their ERM programs, but it's also since been adopted as required reading on the syllabi of the Society of Actuaries and leading universities such as in countries, such as the United States, Canada, the UK, Australia, China, which has been translated into Chinese, Italy, Croatia, Egypt, and as I learned recently at a client, Jamaica. It's my honor to introduce our featured guest CRO, Senthil Kumar. Next slide, please. Thank you, Jay. Senthil Kumar is Senior Executive Vice President and Chief Risk Officer at BNY Mellon. He's a member of the company's executive committee. Senthil oversees the firm's credit risk, operational risk, market risk, and compliance functions. He joined BNY Mellon from Citi, where he held a number of risk and business leadership positions. Senthil was most recently their Chief Risk Officer of Institutional Clients Group, covering markets and securities business, corporate investment banking, private banking, as well as treasury and trade business. He previously managed Citi's risk for financial institutions, public sector, and alternate investments. Prior to joining Citi, Senthil worked at Samba Financial Group, Citi's affiliate, as the head of market risk management and the head of alternate investments. Senthil holds a Bachelor of Science in Mathematics from the University of Madras, India, is a member of the Institute of Chartered Accountants of India, and is a CFA charter holder. Senthil, welcome to the CRO Spotlight.
Thanks for the kind introduction, Sim. Good morning. Good morning to all of you. I'm assuming most of you are in New York, and if you're from other parts of the world, good afternoon and good evening.
So I should apologize in advance. I'm going to be taking notes during our interview so I can really focus my listening on what you're saying. But before we begin, can you please just give us all an overview of BNY Mellon?
Sure. So BNY Mellon has a very extensive history. It's about 237 years old. It was founded by Alexander Hamilton in 1784 in New York. Yes, the same Hamilton Broadway show that you're seeing, the same guy. He founded this bank in 1784. We deliver investments, wealth management, and investment services in 35 countries. BNY Mellon is a very critical and a central orchestrator in the global financial ecosystem. Think of it, we cover 20% of investable assets globally. Just zoom back and see the size of what we do. We are the world's largest custodian. We hold about 47 trillion in assets under custody or administration. And every day we clear about $10 trillion of securities and process over $2 trillion of payments. We also manage about $2.5 trillion of assets on behalf of our customers in the investment and wealth management businesses. So we serve institutions, corporations, individuals, and firms of various size, and we are looking to create, trade, hold, manage, serve, distribute all types of investments. Our firm as you can see, it's been in business for 237 years. We can't be in business for 237 years if you don't innovate. So we lead through innovation. We are, we are currently focused on digital assets and are taking a leading position in providing custody services for digital assets. We use a very open architecture technology platform that enables clients to integrate their solutions, with our, existing, processes. And we are big on the data space and the payment space. So if there's a common theme that if something happens to an organization, the world freezes. That really is true. If we have some problem within BNY Mellon and we are not able to process the trades and transactions, think of how much will be stuck in the pipes, and that tells you the criticality of what the institution does to the financial system. So as a chief risk officer, I'm really humbled and proud to be part of BNY Mellon and its long-standing legacy in this process. So that's what BNY Mellon is all about.
Thank you for the overview, Senthil. And I'm glad you started with a comment about Alexander Hamilton, because that's, of course, dear to all of our hearts. He's an alum of Columbia. He drafted the strategy that eventually defeated the British when he was at Columbia. And I'm actually currently teaching a class in Hamilton building. So we do office hours
I didn't realize
the statue just outside the building. Yeah.
Good to know he was an alum of
Yeah, so it's good to have that nice affinity. You won us all over already. So yeah, you've been a CRO at BNY Mellon for about 3 years. Can you share with us what that journey has been like for you, especially in light of navigating the organization through a pandemic?
Sure. I think the two things I want to highlight. One is I want to talk about what made me come and join BNY Mellon, because I was with Citi for a very long period of time. So before this, I was with Citibank for about 26 years in many different countries. And what made me come to join BNY Mellon, and how did we manage the pandemic and the current Russian crisis, because it's quite an integrated crisis that way. So as a company, the global presence, the rich history, and the critical role that this organization plays in the financial industry is what brought me to BNY Mellon, and the team here was great. That made me that made me feel very comfortable about joining this place, and the journey has been quite remarkable. Within about 7 months of joining, we all decided that we cannot work anymore in the offices, and we need to start working from our homes. Think of it, we have people in about 35 to 40 countries, and we need to make sure that everyone works in a coordinated manner and are well connected. And we do have people in countries like Poland and India, and we have a large set of people in India, and we had to improvise and make sure that everyone is well connected. So we had to rush laptops to each of them, and not only did we give them laptops, we also gave them UPS, uninterrupted power services, in case power goes down, etc., to make everything work and make sure that our resiliency model worked. So that was from an operations, from a technical point of view. On the personal side, we are very, very focused on our employee health, and that's something that that was a key priority. The way we looked at it is, first is your and your family's health. Second is making sure that we serve our customers appropriately, and the third is to make sure that we get to our roles and complete them in an appropriate manner. So there was a lot of focus. Our CEO Todd Gibbons was very focused on employee safety and employee well-being. So we took a stand that we are going to be working from home for an extended period of time. We restricted travel, we put all kinds of enhanced cleaning processes, etc., in place. So that's for employee safety, figuring out how we work. Now when you start working from home, a lot of controls that we have built in is supposed to work in an office environment. Like receiving, faxes on certain machines, receiving the kind of information that we need to use for processing, etc. So we had to improvise and maintain a, significantly enhanced control environment, but at the same time come up with different types of controls, different processes that needs to be put in place to make it work. So we kind of modified close to about 1,000 different controls where it had to be changed to meet the working from home needs. So that was another big experience to make sure that it worked. We spent a significant amount of money making sure our systems are resilient and they work well. And in even before the pandemic, for various other reasons, we used to do constantly stress testing. So one of the tests we did was, let's assume a country completely goes out of the face of the earth. Will we be able, a country where we have a significant number of people is not able to connect to us, will we be able to operate? So we were prepared for any such events where a significant breakdown in communications could happen, and are we able to manage that situation? So that was on managing and running the company. Then the third piece was the volatility and the economic stress that came with it. So and we needed to make sure we function as an organization, continue to achieve our business goals, and at the same time mitigating and reducing the issues that was created by the volatility in the market. So we are always, when I came in here about 2.5, 3 years back, the first thing we implemented was a holistic risk management strategy. I will talk more about it later, and also to take intelligent risk. And when I say intelligent risk, I mean you understand the risk you're taking, you're able to quantify the risk you're taking, and also identify ways to mitigate that risk if we need to mitigate. So those principles really helped us extremely well, and I'm super proud of my of my team, my employees, the organization as a whole. We just were able to adapt to working from home for the last 2 years. We have been doing that. We have just come back to offices as of this Monday, and it has worked well, and we have not suffered any significant issues. We have not had any significant customer complaints. So things worked extremely well. And there were times during the pandemic where the market, because of the market volatility, the volume that we processed was 3 times our normal volumes. The earlier things which I told about 2 trillion and 20 trillion, it was 3 times that, and we were able to process it without any concern. So that showed our infrastructure is well. We have been able to build a significantly good resiliency processes, and our control environment and the enhanced control processes that we put in place worked very well.
So I want to follow up on intelligent risk taking, but before that, as you're talking about how you dealt with lots of different aspects, the business, the people, the controls that you would normally have in the office. You mentioned there were like 1,000 controls, and it sounds like you had ERM, you were prioritizing which ones to focus on as you looked at different scenarios. You call them stress tests of certain areas going down. But I wonder, did you have already in place before the pandemic a pre-existing think through on pandemic risk in different scenarios? And if so, did that help you in how you dealt with it? And how did that play out versus your assumptions?
Sure. See, I think no one predicted a pandemic, right? That's not something that people predicted. Even in January, February, and even when we went home in March, no one expected that we are going to be working from home for 2 years. But having said that, we always are prepared with stress scenarios. So we look at various scenarios. So one of the scenarios was, as I said, we have a large operations in India, and there were floods in a city called Chennai, where we have a ton of work that we do, and the whole city was out for almost a month. We couldn't get back to offices for a month. So we had experienced some of a smaller similar scenarios where a large portion was was taken out, but then we never expected the whole world to be working from home. Not just us, but even our clients and customers. Think of it. It's not only the controls are weakened at BNY Mellon, it's weakened at my clients place also. So this was a very, very unique experience. But the processes that we put in place and how quickly we were able to adapt and modify those processes to meet a different control environment helped. And as you correctly pointed out, having a clear view of your enterprise risk overview helped us a lot in being able to very quickly adjust to a different kind of working environment.
So you mentioned intelligent risk taking, so I wanted to grab on that and ask if you could talk a little bit more about it and how you integrate that thinking into the risk culture of the company.
Sure. So when I say intelligent risk taking, it basically means that whatever risk you take, because you're taking risk every day, everything that you do, there is some risk that is involved. So whatever risk you take, you understand the risk fully. You make sure you know what is the downside in it, on the upside of doing that. And if things go wrong as you're taking the risk, how do you mitigate it? So you need to go into a situation fully understanding that there could be times when what you think is going to happen may not happen, and things can go wrong. And if things go wrong, how do we correct and get back to our normalcy process, right? I'll give a few simple examples, right? I'll start with someone who's a extreme sports enthusiast, who does hang gliding or an extreme sports like that. That is quite a dangerous sport. But then why are people doing that? They prepare for it. They make sure that they are physically fit. They have the right kind of equipment. They have a backup equipment in case the main equipment fails. Make sure that the weather is right. There are no such strong winds and things like that that they need to avoid. Make sure that they don't fly close to each other. So they take all the precautions, and that's what I mean by understanding. Okay, you are hang gliding. Things can go wrong. What will be your downside? Downside, you can fall down and die. So what is it that I need to do to reduce that downside risk as much as possible? And if that happens, or if something happens, a failure happens with my equipment, how am I going to recoup? So even when you cross a road, you make sure that you look around. One, you make sure that the signal is right for you to cross. But in New York, we know none of us do that. We just figure out that we are smart and we can run across the road very quickly. But then you look around to see if there is any cars approaching fast, and and take precautions, and then make that decision. So you don't blindly just walk out. You don't blindly just go in and do a hang gliding class. So those are the things I mean by saying, when you say you take a risk, you make sure you are thoughtful about the risk you are taking, understand everything about the risk that you're taking, and figure out what will be the downside consequences, and make sure that you have adequate insurance in place. If you're I don't know which insurance company will give you insurance for hang gliding, but if it gives you, you should take it, because if something happens to you, you need to be able to protect your family. So those are the things I talk about when I say intelligent risk taking. So we are in the business of taking risk. Finance is a business where we take risk. We take risk every day. Everyone in the organization takes risk. We don't avoid risk, but we take intelligent risk, because unless you take risk, you can't grow. So think of it: if you just keep your money in a savings account without earning any interest, even the savings account is a risk you're taking on the bank. The bank could go bankrupt, right? So you need to evaluate what would happen. Okay, if I do I have FDIC insurance? How much of my deposits are protected, etc. Because if you just keep the cash under your bed, it's not going to go. And then you start investing in the stock market or in bonds, and those are risks that you're taking with an expectation as to how it will, what is the benefits you get. And then if the markets fall, you're prepared to take certain actions to reduce your risk. So that's what I mean by intelligent risk taking.
Yeah, I'm glad you explained it, because of course there's no standard definitions in ERM, and one ERM expert's ideas of things are very different, but under different names sometimes. I'm glad you mentioned both up and down, because a lot of organizations really just look at downside volatility in their scenarios, and it only use extreme downside, and ERM is mostly limited just to capital setting.
Sure.
But as you described, if you're doing both up and down, then you can really use it for risk reward decision making and effectively navigate a better strategy, execution on that, etc. So
yeah, so there is nothing like risk on its own. It is risk and reward. So how much risk are you willing to take? It depends on the reward that you're going to get. Let's assume the risk level is the same for two situations. In a situation where you're investing $1,000, you're going to make $10, but the risk is the same. Assume another situation where you're going to invest the same $1,000 and you're going to make maybe $200. So the risk reward equation is so different on the other one. You are going to go into the second situation. So risk is not a standalone entity. It's risk combined with reward always. So that's the reason why that's the equation that one needs to look at together.
I'm glad you used the analogy of putting the money in your mattress, because it's really a current example that people can latch onto. It's so many average Americans don't understand this concept. When you talk to them about volatility, retail financial planning, I think, is not really suss out in a sophisticated way what people's risk tolerance is and explain to them in a good way. So I'm actually, of course, I do this not pro bono for family members, because I'm good at projecting, and I have a family member who's trying to retire, and I'm trying to explain how they should allocate their investments. And I want to be safe. I'm like, okay, well, if you put it all in bonds, look at the projection of how you run out of money faster. So
Sure.
it's not safe, right? You got to accept the volatility. You're going to be, 20, 30, 40 years we're talking about. So you got time, but if you don't put it in stocks, you're not going to. So what is safe, and translating it to the way people understand? And I think that's what we do in ERM too, is make things more clear to senior executives of what the volatility around objectives really is, and to tease out different risks and highlight some that they forgot about maybe or didn't understand, and others that are not as important as they maybe thought they would. Just getting the hard, cold numbers about it. So.
Sure. As I mentioned earlier, we are now moving into digital space, right? Cryptocurrencies, etc. And this is an uncharted territory, and so we are making sure that as we get into it, we have a very clear risk framework to manage the risk, identify all the risk extensively, and see what are the risks we are willing to take, because there are some things that we can mitigate. So because think of it, if you're able to mitigate every risk, there is not going to be much of an upside. So there will be certain risks that you will take, and that's the risk acceptance process. That's the risk reward that you're talking about any activity that we do.
Wonderful. And I'm thinking about as you're getting into a new area, and earlier you told us about the tremendous difficulty of navigating such an important large organization through a once in 100-year event. But also the upside is, of course, you learn so much sitting in your seat, going through that I think it gives you a lot more comfort in facing new initiatives, because you just learn so much through this process. So would you agree that kind of upheaval and volatility is painful, but
I 100% agree with you. You never, waste a crisis, right? You learn out of it. The first time I really had to, work fully in a crisis situation was the 2007-8 financial crisis. And I think the lessons that I learned, you cannot learn it, with books and others, for any amount of time. So, and we have to improvise, because there is, so that was one, right? Now the pandemic, that taught us so many things where we had to improvise and, make things work. So crises are great learning situations.
I think we're all at the point of this crisis where we're ready to move on from our learning to a little bit more stable environment. But we'll see what the virus tells us. Can you tell us though? I was wondering about this. Can you tell us how has effective ERM supported your holistic risk management strategy?
Sure. So as I said, initially when I came in, we introduced a holistic risk management strategy and intelligent risk taking as two principles with which we are working. So when I mean a holistic risk management, principles, it is grounded in a few things. One is a very strong risk culture across the company. People need to understand risk, because we are in an industry where we take risk every day, and people need to fully understand the risks that they take. And that will only come in if you have a strong risk culture across the company, and a very clear risk ownership by the business and the functions that are taking the risk. Because when you take the risk, you're not expecting someone else to manage the risk for you, because you own the risk and you need to understand the risk you're taking, and you need to be on top of it. And the third is a comprehensive risk oversight by the second line, which is the risk and compliance department. That is where we come into play. So that's been our cornerstone of how we are managing our risk, and our enterprise-wide risk management function focused on designing a company-wide standards. So let's step back. What does it how does it really work is we have a very clear risk appetite. Okay, how much risk does this bank want to take? And that sort of drives what we do in each of the businesses, how we what kind of in individual risk within the businesses that we take, etc. And we also want to make sure we have a risk taxonomy that is aligned across the organization, both the financial and non-financial risk taxonomy. So people, when we talk about a risk, we all understand what we are talking about across the company. And there are various reviews, etc., that have been designed to make sure that we are within the processes that we are supposed to be doing.
How have you advanced your ERM program, and how has that contributed to the program's success?
Sure. So as I said, we are as you could have picked up from what I'm saying, when you say please analyze the risk you're taking, how do I make sure that I have a full window on all the risks I'm taking, right? So we instituted something called a triangulation process, or a 3 lenses of risk management. One, what type of a risk is it? Is it a credit risk, market risk, operational risk? So that's the risk type that we need to look at. Second, where is this risk being taken? In what business is it being taken? Is it being taken in the markets business? Is it being taken in the asset servicing business, etc.? So we need to use the lens of the risk type, the lens of the business in which we are using it, and the region and the legal entity, because each place, Asia has certain different, in nuances, Latin America has certain nuances, and each legal entity has certain different requirements. So we always go and use these three lenses to make sure that we are not missing any vital risk from, and making sure that we are looking at it from all the angles. We also went about to re-engineer, as I said, our risk appetite and limits framework. Make sure that we understand what is the amount of risk we are willing to take. Let's assume we are a very highly rated bank, a AA minus rated bank, and what is the level of risk that a bank, because it's paramount for us that we maintain our good rating that we have, and to maintain that rating, what kind of volatility can I have in my earnings? And if that sort of is the volatility that I can have in my earnings, what kind of portfolio should I be having? What kind of loan portfolio I should be having? What kind of the investment portfolio I should be having, etc. So it kind of keeps falling down. You understand where your total risk is, and then keep looking at the individual aspects and determine what is your risk appetite. Once you determine your risk appetite, then to make sure you manage your risk within the risk appetite, you put in limits framework. And these limits framework ensure that whatever activity that happens underneath is within the risk appetite that we have taken for the organization as a whole. So that's kind of the process that we have put in place to make sure that our risk appetite works and it is within a ERM program. And again, if you look at it, it all goes back to the risk you can take, amount of revenue you can generate, and how do you sustain using the right kind of controls, run a very resilience program, etc. So all those things form part of our risk appetite framework and limits framework.
I'd like to get into a little bit more granularity now to understand there's so much variety of practices. Can you tell us how is risk both qualitatively assessed and then quantified at BNY Mellon, and how is risk analysis used in business decision making more broadly?
Sure. Our corporate risk assessment is, as I said, is a guide, right? It sets the tone for the risks we are willing to assume and pursue, our strategic, objectives. We refresh it annually. We as a business team, the executive committee members review it to make sure we are all on the same page as to, okay, this is what the company wants to do. It also describes qualitatively the tolerance for the types of risk that we want to take, and it guides us in making the key decisions on our strategic and financial planning processes. Say, for example, we can't go in and say, I'm suddenly going to grow my revenue from X to 10X. That growing it to 10X would cause significant amount of additional risks to be taken. Is that within our risk appetite? So those are the kind of evaluations that we do. So once we have done our risk evaluation as to what our appetite is, then we go through a whole risk identification process, and we look at all the risks that are embedded in a particular activity that we do, identify them, and then try, and some of them are qualitative risk, like a fiduciary risk that you take, where if you tell your customer that I'm going to do X, Y, and Z for your account, I need to make sure that I do that X, Y, and Z, and I don't miss out on anything. So those are things that are qualitative that we need to put in controls and processes in place to make sure that they work. The other is the quantitative piece. Let's assume the value at risk. I'm assuming the students would understand. When I talk about let me not even go into war. Let me talk about, okay, this is the amount of money I want to lose in a particular business. I want to make sure that the underlying positions that we take, the various market positions that we take, in a 1 in 10 scenario. I normally go with a 1 in 10 scenario as the rule of thumb to say, am I how much money will I lose in this particular environment, and is it within my risk appetite? Because you can't run a business for a 1 in 100 event. That is an exceptional event. So there will be times when if I'm running my books on a 1 in 10 scenario and a 1 in 100 event happens, we will take losses, right? So that's the thought process with which we are very clear about how we convey that to our teams, to our board, so there are no surprises and people understand the risks that we are taking and the expected outcomes of the risks that we are taking.
If I could dive in a little bit more, and if I'm asking at a level of depth and not able to speak about that, that's fine too. We could just move on. But I'm curious, how do you do your risk identification? How often do you? So do you? People do it different ways. Sometimes there's group meetings, sometimes there's one-on-one conversations, and then there's group meetings afterwards. It's done confidentially. People score things qualitatively, and then the whole group assesses it with consensus meeting, and then sometimes people have just a smaller executive group come up with a list of risks, and then maybe it's vetted later. So it can go sideways, up, down, coalesce. There's so many different ways of doing it. Whatever you could share with us about the steps involved.
Sure. It's a combination of a bottoms-up process and a top-down approach to risks that we take. So there is a forum. Each business has a business risk committee, where the CEO of the business, the CRO of the business, the compliance head of the business, and the various operations head, everyone participates in it. So that's the forum where we start generating our list of risks that we take in the business. It gets debated, it gets reviewed, it gets challenged, and then people come up with, okay, these are the, say, let's assume the 15 key risks that we are taking. And the second thing we do is, okay, quantify the key risks, which are your top risk, which are your moderate risk, which are your low risk items that we take. So once the bottoms up process is reviewed and done, then we apply a top down. What do we expect a markets business to have? What kind of risks are we expecting that to have? Make sure that they match, they've captured it, and if not, enhance the list of risks to include those things. And then that gets reviewed by the business head, the chief risk officer of that particular business, and the chief compliance officer, the whole senior management team in the business, and they agree, yes, these are the key risks we take, and these are the kind of categories within which I would put those risks, and then look at it to see whether we have identified all the risks within the businesses that we take. So that's the process. It's an iterative process, and we go in and refresh our risks on an annual basis, but on a quarterly basis, we go and make sure that we have not missed out anything, or any new risks that have arisen gets added on to that.
Great. So
does that answer your question, sir?
Yeah, I think so. Just a couple of follow-ups on that. In terms of the ones you quantify, do you look at 1 year out capital, 8 quarters out capital? Do you look at present value, impact on value? How do you ROA? Like what metrics do you use, or is there a combination for the quantitative? And also, since some of your risks are done quantitatively and some qualitatively, how do you combine that information?
Sure. We have key risk, indicators that we put in place. So for both for our qualitative and quantitative, metrics. So I'll give an example of, market risk, because that's an, easier example to, give. Let's assume my total monthly, revenue is X, and that's amount of money the markets business is supposed to be, making. And how much money do I want to lose in a month? Or how much money can I afford to lose as a business and then still continue? Can I lose 1 month's business, 1 month's revenue, and will I still be able to continue? Can I lose 2 months revenue? Can I lose 3 months revenue? So there comes a stage where we say, hey, this is it. If we lose more than this, our whole organization will get significantly impacted. So we go through the analysis to understand what is the appetite we have for losses in a particular business. So that becomes one guiding factor. Once we know that, we said, okay, now let's put what are the activities that the business does, and what kind of combined, because there will be activities that will offset each other, etc. What is the combined impact of the total risk I take, and what could I lose with a 99% confidence interval in a day, and extrapolate it. And as you know, value at risk does not really capture all the risks, and it is not the best indicator of risk. So we look at a VAR process, and we also look at a stressed VAR process, which is a stress scenario. How much will I will I lose? So we take those two guiding principles and fix limits based on them. So if those are the limits at the top level, then we go to a level 2 limits and the level 3 limits, which go to the individual products and then to the individual desk level. All these limits are monitored on a daily basis. The mostly daily basis. The quantitative ones are maintained on a mostly daily basis. The qualitative ones are a monthly cycle where we manage it. And so that's the way the whole process works. And it all gets reviewed in the business risk committee meetings, and then it gets escalated to me if there are any issues.
I was going to ask you about risk governance, because you started to describe this process. That you gave us a picture of risk governance, but can you talk about it a little bit more broadly? Your risk governance structure, the board's role in risk oversight, and just ensuring your success.
Sure. As you know, in the financial industry, we talk about 3 lines of defense. There is a first line, that is a business, the people who go out, sell the services, manage the services, provide the products and services to meet the company's business needs to the clients. So they are the first line, and we think of them as the first line of the battle. They are closest to the business, they're closest to the risk that we are taking. They will be the best to identify and address the risk. So that's why I said, when the first line needs to fully own the risk culture, have to, own the responsibility for the risks that they take, and have to apply intelligent risk taking, processes, when they take the risk. So that's the first line. They are the ones who own the risk within the organization. Then comes the second line, which is where my team, comes in. And here we establish the policies, the processes, the risk appetite, the guiding guidelines as to how we need to manage the risk within the the risk appetite that we have established. So the business cannot just come in and say, okay, I want to take 10x risk. No, it needs to fit in within the overall strategy of the organization. So that's where we come into play and make sure we manage the risk appetite of the company, and we put in processes in place to make sure that we are operating within the risk appetite of the company. So those are the things that my team does there. I report jointly to the CEO of the organization and to the risk committee of the board, because that risk committee of the board reporting gives me the independent nature that I need to manage the organization, and that's a critical piece of how the governance works. Then there is a third line, which is the internal audit function. They step back. They are kind of the last resort. They review the processes that we do, post all our work to see if we are really operating appropriately, we are operating in a controlled manner, etc., and come back and give thoughts as to changes that needs to be done. And the risk committee of the board is made up of independent directors. They oversee the company's risk management policies and practices and our global risk framework. And the committee delegates the day-to-day risk management responsibility to the internal senior risk management committee. We call it the senior risk and controls committee. And I am the chair of the committee, and the members include the CEO, CFO, and other business executives. And underneath that committee, we have 16 other committees which are responsible for various areas of the risk management, and it all comes together. So that's how the whole governance structure is, with the board risk committee taking the ownership, delegating down to the internal committee, and then we managing it, and I reporting back to the board on that.
Thank you. That gives a nice clear picture of your governance regarding risk. I want to ask you, BNY Mellon being a major globally important financial institution, you're highly regulated. So what is your approach to communications with regulators regarding risk information?
Regulatory supervision is is an important dimension of the industry-wide risk management. They want to make sure that the risk management practices that are being followed within the industry is appropriate. Make sure that the best practices are being implemented in all the organizations, etc. So effective regulatory relationship is very critical for us, and it's, in my mind, it's very simple. We need to have a very open and ongoing communication, because in my mind I actually look at them as my partners, because my goals and their goals are the same. We want the organization to run in an efficient manner. We want the organization to run in a very controlled manner, and so to that extent there are some similarities in our objectives as to what we are required to do. So very clear and accurate information flow, timely review with them, such that they don't feel that there are any surprises for them. And we need to have a sense of what they want their needs and expectations to supervisors and make sure we provide them that. And at the same time, we also need to make sure that every business is unique. My business, BNY Mellon's business, is very different from my previous company, Citibank's business. It's a universal bank compared to us, which is a very different organization. So we need to make sure that the regulators who come in also understand our businesses and its nuances, because if they don't understand us well, they won't be able to regulate us well. So it's a combination of making sure they understand us, making sure that they get the right kind of information, making sure that we are aligned in our thoughts as to what we are doing and why we are doing and how that's going to be beneficial for the industry as a whole.
Yeah, I wonder if you'd agree with the statement that one of the tricky things about these kind of communications is bridging the gap of communication. So it just sometimes if there's a perception that something is missing or not as robust as it is, but it is, that's the saddest kind of, and people coming from different perspectives, different understanding, different language about risk. I've seen some companies make a misstep with that. Would you agree that that's a particularly tricky part of the relationship?
Yes, no, you're absolutely right. That's the tricky part. That's why we should have the right kind of alignment. One, they need to understand our businesses and risk. We need to educate them on that, and we need to make sure that we are focused on managing the organization in an appropriate manner.
What do you see as some of the challenges ahead in achieving your vision for holistic risk management?
The most important challenge is to have a strong risk culture. Because if you have a strong risk culture within an organization, everything else falls into place. So to have a strong risk culture, everyone must embrace that they are being a risk manager. Whether you're a technology person, think of it, you're a technology person on a weekend making a change in your systems programs. You are taking a risk on behalf of the organization. Right? So you need to think the change may not work, change may create additional problems. So you need to think through to say, hey, I'm taking a risk and making that change. Have I thought through what is the risk I'm taking? What are the downsides? Have I protected my downsides? So that is the concept where everyone in the company is managing risk, and we need to embrace being a risk manager. Second is do what is always right. Act with utmost integrity, and we have a code of conduct which ensures that we have certain principles that we follow as a company and make sure that we manage that company in that way. So those are some of the key items that is important for an organization to function well, and for us to make sure that we have a holistic risk management approach to how we manage an organization.
You mentioned risk culture quite a bit through our discussions. It sounds like you're very focused on culture, which is very important. How would you describe your leadership style?
Let me step a little bit back. When I say I need it. See, at the end of the day, it all depends on the team that is working for you, and that is what is determines your success as to how you work and how you are able to deliver. So you need to build a high-performing team, and to build a high-performing team, we need to have a diverse set of people. If everyone around the room, let's assume they're all from one particular place within a span of 5 miles, and their thought process is going to be very different from a team which has people from across the world and has a very diverse view of things. Because even a simple thing, my kids were all were brought up here. Their thinking on a particular problem to my thinking, where I was brought up in India, is very different, because I was brought up in a culture where we need to repair things and then reuse. And here, the thought process is just throw and get a new one. There's a very difference in things. There are times when you're not able to get a new one. What do? You have to repair and use it. So there are things where when you include people from different parts of the globe, the thought process, the approach to a problem is very different, and that diversity is needed for us to get the best out of an organization. And second, I'm very big on learning and development, and I make sure my teams go through a very stringent learning process. So when I came in, I said, guys, I'm a constant learner. I keep learning and reading books, taking on online courses, etc., to make sure that I'm fully updated, even in things which are not related to my area of work. So I encourage people to learn, because it's nothing is standstill. we need to be constantly moving and keep learning. So we have developed significant amount of learning and development programs for my team, and I've mandated everyone in their goals that they need to spend 7 days of their every year on learning and development activities. So those are things that are very, very important. Now, you asked me about my leadership style. If you want to succeed in this is something which I learned very early in my life. And my dad, who had done extremely well in his career, he said, if you want to make sure that you build a strong team and make it work, you need to focus on people's strength, not on their weaknesses, but you ought to help them on their weaknesses. Because if you think of this, and this is a classic example which we see in the social media circulated around. If there is a race to climb a tree, and you have a monkey and a crocodile, that's not a right comparison. Everyone has different strengths, so make sure you play to the strengths of the people and play and help them in their weaknesses, and play to the so focus on what the strength is, and we as a team need to succeed together. So giving opportunities to people where they can excel and helping them is something which I really focus on, and that's something that and that's the reason why we have developed some very good training programs within BNY Mellon, a mentoring program, a cross training program, and an executive development program. A cost training program is a very very interesting program that came about because of necessity. At a point in time, I had a very small team of about 15 people, and when someone goes off on vacation, no one was there to do that particular person's work. So I said, guys, this is not going to work for us. So all of you have to spend 20% of your time in someone else's role to understand that role. The main purpose of when I first introduced it was to make sure I have continuity, when people go off on vacation. But that turned out to be something where people learned a different skill and wanted to do that and move from one area to another. That's taken off, and it's been a huge success within the firm. And that's something we strongly encourage, because I don't want someone to be in my career. I did 8 different jobs in my from being an internal auditor to being a market risk manager to be managing money to etc. So I want people to take different roles, and I've seen people doing the same thing 20 years, 25 years. That's not the right recipe for success. So so that's the that's the reason why it's become a huge success and people like participating in the program.
It's really interesting because a lot of times, accidents or things by necessity, then we innovate, right? So many discoveries have been made by accident or by, having to do something. And I wonder if, I'm assuming that with the cross-training, not only do people find a job they want to do, but even if they just do that and are prepared to step in, they gain a deeper empathy and appreciation of everybody else on the team, and they can relate better, work better as a team. Do you find that's happening?
Exactly. You're spot on. That's the best out of the best outcome that comes out of those cross training programs.
Wonderful. So let me ask you a fun question. What do you find most rewarding in your role as CRO?
I'm a change agent. I don't like status quo. I'm happy with status quo if everything works well, but there is always ways to do things better and constantly look for change. So that's something which I like doing, and I'm a change agent in general. It's also very rewarding to watch talented people excel. For me, as a where I'm at a stage in my career where I've seen people who were working with me have done phenomenally well and have taken on much larger roles, have started companies, have flourished, etc. So the pleasure of watching someone whom you mentored doing extremely well in life is a huge reward I know as a leader. And also it is very rewarding to know that our investments in the holistic risk management process that we are putting in place is helping the company grow sustainably well and to reach its goal and to grow in a very a very controlled manner. So overall, I think seeing what you do give results is quite rewarding. In not only either it is a work related thing or something personal that you want to change the way you do and bring innovation into place, or watching your people who are in your teams who do extremely well in life. Those are all quite a rewarding process.
Yeah, that's something we can definitely relate to. And in School of Professional Studies is where we sit within Columbia, and we're all scholar practitioners, so we're actively in the market and doing the academics as well. And that's something we all, it's cruel helping a company, but when you look in the eyes of someone and know that you're helping change the trajectory of their career, that's the most rewarding thing. So I'm glad you feel that as well.
I like mentoring people. I like, so when people come and talk to me, I spend a good amount of time to, make sure that I really understand what they're trying to ask and help them wherever possible. It's quite rewarding.
Before I open it up to Q&A, and people, you can type in your questions in the Q&A, and I see a couple have already. I just want to ask one last question. What advice do you have for our students and graduates entering the risk management field? What skills do you look for on your team?
Sure. One, there is no substitute for hard work. Right, so that's something I really like to tell people. You may be super intelligent, but if you don't put in the hard work, that is not going to help. Second is make sure that you're well-rounded. You don't just you take on a broad set of subjects trying to understand them, but whatever subject you take, don't be superficial. Try to understand it in depth. Those are things that will really help you. And the other thing which has helped me get the progression in my career is to roll up your sleeves attitude and make sure that you fully understand what you're doing. Then I always take tough problems. It is good to take a tough problem. Even if you fail, that's okay, but take a tough problem and work on it. Working on an easy problem and solving it is not, that's going to take you to where you want to do. Ask for work outside your existing skill set. Only then you're going to stretch yourself and learn. And always, I always pitch to seniors solutions without being asked. I'm not going to wait for someone to ask me and go in and provide solutions. And another thing which I found rewarding is move around the globe. There is no need to work just in one place, one country, one city. Take the opportunity. The world is has a lot of opportunities, and go around and work in different places. And the last one, this is something which my one of my mentors and bosses told me. He said, Senthil, there are 3 types of employees. One is an employee who needs a lot of hand-holding, coaching, etc. Second is an employee who does all the work extremely well and is great. I don't need to do anything to manage that person. Third is an employee who does all the work extremely well, but constantly comes to me and asks me for more and to be managed. Give me more exposure, etc. And he said, Senthil, you are the third kind of an employee. Please be the third kind of employee. It is great to be the second kind of employee, but for you to grow, for you to take on more, demand to be managed. Your manager gets paid to be managing people, not to give them a free ride by doing everything well and keeping quiet. So demand to be managed. I think that's where I will stop, and I'll be happy to take any further questions, answers, etc. from the team.
Thank you. So let me look at the questions that have been posed. Okay, here's a part of the question. How big a priority is ESG now, and how big do you see it being in the future?
I think it's very good to see that the focus has come in, and many regulators are coming in from a regulatory stick to do that. But that was what was driving most people to look at ESG. But now the social conscience has come into most organizations. The organizations themselves are going in and saying that how we want to be ESG friendly, and that is catching up. That's pretty big. It's a big wave, and I think that's going to continue. And it's the right thing to do, and it's going to increase. ESG is going to be a very focused topic for many, many more years to come. It's a real problem. I strongly believe it is a problem, and of course, people have varying views on whether ESG is an issue or not an issue. I personally think it's an issue. We need to make sure that we are protecting our environment and making it suitable for generations next to us to come and live and be happy.
Here's another question. I don't know if you can address this, but what are the top risks you're focused on managing at the enterprise level?
At this point in time, I'm focused on the current situation in Ukraine as to how that would Russia-Ukraine situation and how that could manifest into risks for us. One is the market volatility. That's something we are pretty used to managing. That's something we need to manage. And the second is all the sanctions and sanctions related issues and how we need to navigate that and make sure that we make it work. And the third and the most important one is cyber risk. What happens if my systems gets impacted? What happens if the international systems like SWIFT, etc., get impacted? How do we manage those situations? So those are the current ones that I'm focused on. But at the end of the day, one big thing which I'm also focused on is people risk, because this pandemic has shown that you are not tied to a particular region or city. You can work from anywhere. So earlier we have a large setup in Pittsburgh. So some of my people in Pittsburgh were, we knew we were one of the largest employers, and we knew that we are going to have them for a period of time. Now, someone in my team has gotten a job from a company in San Francisco. They said, no, you don't need to move out of Pittsburgh. You can work from there. The opportunity set for people has opened up. We need to make sure that we manage our people appropriately, make it attractive for them to be part of our company, and that's one of the reasons why we have adapted a very flexible work environment within the financial services industry. Ours is very, very flexible, and those are things that we are focused on to make sure that we manage the people risk appropriately.
Yeah, I'm glad you mentioned that, because that seems like one of those things that's going to be a permanent change. We've gone through this, we've proven that so many jobs can be done more productively remotely. Some employers doesn't fit the culture. They want, of course, there's not just the individual productivity, but how we help others' productivity, which also happens maybe more in the office. So, and then access to people. And so there's so many disruptions and changes. I was talking to a CRO the other day, and we were saying, well, what's going to happen to all the corporate real estate? And I thought, I don't know what you think, but I thought maybe some organizations are going to get rezoned so they can take half their empty building and make it residential for their employees at a discount. So they get their people there, keep them local, can get the benefit. There's lots of different things that we can't expect yet, but we see major shifts coming in how we work and how we hire. Do you agree that that's going to be a major outcome of this after?
No, I think that's an interesting thought, to convert half the office building into residences. I don't know whether I would want to be in one of those residences just above my office, but yes, that's an interesting thought. But you're right, things have changed, and we have identified that there are a lot of things that can be done very efficiently working from home. But I would not underestimate the benefit of being in an office space. The camaraderie, the collaboration, the quick meetings, that as you walk by, you talk about a particular item. Those things will not happen when you work from home. So there needs to be a hybrid model, a right kind of balance between being present in an office environment and then working from home, and that's what is going to be a successful strategy.
It's funny as you say that. I'm just thinking of a tiny example from my personal. So I have just a boutique here in consulting firm. I had a couple of my staff. We were working on something, and usually we were working remote or in the office. But in this case, we were working in the office, and we were doing things side by side on a laptop, and just seeing some keystrokes they were doing. I'm like, what is that? What are you doing? How'd you do? Seeing these shortcuts, these kinds of things, being physically present with people, observing them, listening to them, overhearing things as you say. Yeah, it's hard to put a number on that, but it definitely is there and is missed elsewhere. Let's see if we can sneak in one quick question before we wrap up. Compared to Citi, sources of risk at Bank of New York Mellon are likely more operationally focused. What are the challenges of determining unexpected downside for operational risk compared to market and credit risks?
Sure, I think that's a very interesting question. That's what drove pushed me to take on this role at Citi. The risks that I ran, especially with the Citi ICG division, we had the largest global. I don't think there is anything larger than Citi's credit risk profile globally or market risk profile globally. So both were very, very large pools of risk. I did not have responsibility for an operational risk there, but the operational risk that BNY Mellon takes is quite significant, and that's what drew me to come to join BNY Mellon. Now, market risk, credit risk, it's standardized processes as to how we may measure and manage risk. In the case of operational risk, it's a lot of indicators that we need to look at to manage our downside risk. Think of it. Let's assume we we make a payment to someone which we should not have made. The Citi Revlon case is a classic example of an operational risk where they moved close to $900 million out of the organization when they should not have done. And how do we make sure that those issues do not happen? What kind of controls do we have in place? How can we automate the controls? How can we bring in artificial intelligence and machine learning into the process to manage those? Because as I told you, we process over $2 trillion worth of money per day. And when we process that significant level of volume, we need to have very intelligent processes to manage the risk, very robust control environment to manage and make sure that we process them appropriately.
Great, thank you. We're out of time, but just before we say goodbye, I just want to wrap up with five things I pulled out from our discussion and remind everyone. Senthil reminds us not to waste a crisis, to learn from it. Challenges to 7 days of learning and development throughout the year. Tells us to work hard, of course, good advice, dig in deep, go in depth, and roll up your sleeves, and be the kind of employee always asks for more. Thank you, wonderful discussion. Thanks for making the time out of your very busy schedule to share that with us, our faculty, our alumni, students.
Oh, thanks a lot for having me. Sim, I think it was a good discussion, and I think you captured my key points very well. And good luck to all the students who are listening into this. And happy, please please feel free to reach out to me if you have any thoughts, questions, etc. And I'm sure Sim and team will be able to share my details.
Wonderful. Thanks so much.
Thank you. Thank you.